Inflation is at a record high across the globe. US is experiencing 40-year highs in inflation rates. India is also experiencing very high inflation rates. So these are very difficult times. There's a war in Ukraine. There are supply chain constraints across the world, COVID in China. So many things that's not happening the way it should. Midst of all this, retail investors are looking at where they should deploy their money. Is it equity or debt? And that's really the question that we're trying to answer today. Fundamentally, equities across the world have already made a deep correction, especially in the Western world. US markets have seen a deep correction in their equity valuation from their all-time highs. India, we've been fortunate. We've not seen such a bad correction. Of course, there has been a small correction. There's been a small churn internally, but equities haven't kind of done too badly in the last 1 year. However, going forward next 12 months, what is the view? What is the best asset class that can generate great returns for investors? Our own view is debt is the place to be. Equity, while is a great long-term investment product, 10-year returns on equities continues to be very exciting. I think the next 1 or 2 years is going to be a challenging time. Equity markets are going to be very volatile, and debt is going to be an interesting space to explore. Now let me give you the reasons why. Typically, when inflation goes up, the way the central banks around the world control inflation is through what is called a monetary policy. The monetary policy measures for controlling inflation include raising interest rates. So over the last, say, 9 months to 12 months, most central banks, the Federal Reserve in the USA and the Reserve Bank of India, have been steadily raising interest rates. 0.5%, 1/4%, 0.5%, 1/4%, so on and so forth. Even in the latest round of interest rates, as late as last week, the interest rates have been continues to be raising. And both the Federal Reserve as well as the RBI is clear that these are not the last. There's a little distance to go before they kind of say it's done. So we expect interest rates to continue to rise. Now what this means is that there is a significant amount of money that has got sucked out of the banking system. In fact, there are reports that tell us that out of 8 lakh crores that the Indian banking system had a year ago, that number is significantly down to 1.6 lakh crores now, which means that an entire scheme of money that allowed the banking system to operate at low interest rates is now out of the system. And that also means that the interest rates have moved up. Because interest rates have moved up, people have been a lot more careful where they spend money and how they. So demand is also a little bit muted at this point in time. Having said that, how does this impact debt investments? Any debt investment, especially bonds, have an inverse correlation with interest rates. As and when interest rates seem to go up, the bond prices seems to go down. The classic example is, if I've already invested in a 100 rupee face value bond, which is yielding say 9%, if tomorrow the interest rate for a similar bond moves up to 10%, what really happens to the bond that I already hold is that because it's generating 9% and tomorrow the market expects the same bond to generate 10%, the only way a 9% coupon can generate 10% return will be if instead of 100, it is sold at 95 rupees. It's a very simple and an elementary way of explaining this concept, but that's the way bond prices gets kind of depreciated every time interest rates moves up. Now, over the last year, we've seen a tremendous amount of depreciation in these bond prices. But the good part is, although they have depreciated, they're also yielding a higher return now, because on 95, you're going to get 9%, which means that the yield is going to overall be much higher than before. So as and when the interest rates hikes at the central banks stop and the interest rates start becoming softening, some of these bonds prices will shoot through the roof. So if somebody has a time horizon of say 3 years and above, then these are great times to invest in these long-term bonds. Now, as an investor, you may wonder, do I know which bond to pick up? Do I know how to kind of make that call? If you don't have that, then you can go to any of the debt mutual funds. You have a lot of medium-term bond funds which offer the same facility. Only thing there, the mutual fund manager chooses the bonds for you. Therefore, even if you don't know much about bonds, you will get the returns that you seek. So they are great investment. The second reason why you need to invest in these 3-year plus bonds is that over 3 years, the taxation for bonds is considered as long-term under the mutual funds. Now, if these are long-term mutual funds and you stay invested for a 3-year period, especially before March, if you enter these, you're eligible for what is called a multiple indexation. Now, typically, any long-term capital gain will also have the advantage of what we call an indexation benefit. Now, assuming a 4% indexation benefit, which is linked to your inflation rate, which I think is very reasonable to consider a 4% rate, you make a significant post-tax return over a 3-year period as compared to an FD. These are why we believe it's a great time to look at debt mutual funds from a 3+ year horizon as compared to traditional investment products. Having said that, the entire debt space also looks interesting. Even if you have a 1-year kind of an investment today, the rates are more closer to about 7.5 or 8%. These are very, very good times to deploy your money in debt. On the contrary, with all the money getting out of equity market and circulation, people who used to speculate in stock market are now kind of finding it very expensive to speculate. So we expect that the stock market returns, at least in the next 1 year, will tend to moderate as compared to go up. So in summation, I would like to say that these are great times to revisit your portfolio and look at a higher allocation to debt. And these are one of those times when even a non-exciting debt investment will look very interesting for investors as long as they stay true to that 3-year kind of horizon for debt mutual funds, and for bonds as well, they can look at it in the long term.